Let's go back in time. Imagine a world without banks. People kept their gold and silver coins at home. This wasn't safe. Thieves could easily steal your life savings. That's where banks came in.
Early banks were like secure vaults. People deposited their valuables for safekeeping.
Over time, banks evolved. They realized they could lend a portion of these deposits to others. This is how lending became a core banking function.
Fast forward to today, and banking is more sophisticated. We have online banking, credit cards, and international transactions in an instant. But the fundamental principles remain the same.
Banks serve three primary functions. First, they provide a safe place for your money. Think of your checking and savings accounts.
Second, banks lend money to individuals and businesses. This could be for a home, a car, or business expansion.
Third, banks facilitate transactions. They make it easy to pay bills, receive your salary, and move money around.
These three functions are intertwined. Deposits make lending possible. Lending fuels economic growth, and efficient transactions make it all run smoothly.
Here's a fascinating concept. Banks don't just manage existing money, they actually create new money. It's called fractional reserve banking. Let's say you deposit $1,000. The bank is required to keep a fraction of that deposit as reserves. The rest can be loaned out. The borrower then uses that loan to make a purchase. This money is deposited back into the banking system, allowing for another loan. This cycle repeats, creating a multiplier effect. The initial $1,000 deposit can lead to the creation of several $1,000s in new money. This process is essential for economic growth, but it also requires careful management to prevent inflation. The bankers cut understanding interest and bank profits. Banks are businesses. They need to make a profit.
Their primary way of doing so is through interest rates. Banks charge a higher interest rate on loans than they pay on deposits. This difference is called the interest rate spread.
For example, a bank might offer 2% interest on savings accounts but charge 6% interest on loans.
The interest rate spread allows banks to cover their operating costs, make a profit, and maintain reserves for potential loan losses. Interest rates are influenced by various factors, including central bank policies and overall economic conditions.
The Maestro central banks and the Symphony of finance. Central banks play a crucial role in the economy.
They act like conductors of an orchestra, influencing the flow of money and credit. One of their main tools is setting interest rates. By adjusting these rates, central banks can stimulate or cool down the economy.
They also regulate banks, ensuring they operate safely and responsibly.
Central banks play a vital role in maintaining financial stability. They act as lenders of last resort during financial crises. Their decisions impact inflation, employment, and overall economic growth.
New kids on the block, digital banks, and the rise of cryptocurrencies. In recent years, we've seen the rise of digital banks and cryptocurrencies.
Digital banks operate entirely online, offering convenient and often cheaper services. Cryptocurrencies like Bitcoin are decentralized digital currencies. They operate independently of traditional banking systems.
These innovations are disrupting the traditional banking landscape. They offer both opportunities and challenges.
Digital banks provide increased competition and convenience. Cryptocurrencies challenge the established financial order. It remains to be seen how these trends will reshape the future of banking.